Good morning, this is Ken Long from Tortoise Capital Management with a review of the weekend trading reports for November 3rd, 2012. We are still in a bullish normal market. On an annual basis, using weekly RSI 14, we're at 55 out of 100 or neutral. 10-day basis, using 10-day NDX, we're at 19 out of 100, so slightly oversold. Percent stretch above the 200-day moving average is 3.29%, so we're red bullish, 1.3% away from sideways. Slope of the 50 is rolled over to yellow neutral at 0.03%. ADX 14 is neutral, no trend at 17.5. ATR percentages increased to 1.16% at the high end of normal. Monthly rebalancing occurred last week on the 26 ETF portfolio. It's IEV, which is the Euro 350, Financial, Spider, and China. In 13 ETF, it is the EFA, which is the Euro-Asia Blend, EPP, Asia less Japan, and EEM Emerging Markets, with next reevaluation due on or about 1 December. In the ETF2, the theoretical exposure is 70%, and the model portfolio itself is at 80% exposed. Quick look at the blended monthly balancing portfolios. You can see about half of them are on a cash, and you can see the top one, 1 through 13. About half of the extended portfolio is also on cash, meaning their price is less than the 4-month moving average. Quick look at the market health check. Vertical blue lines are 10, 20, and 30 days of look back. Horizontal purple line is the swing high at 147 and some change, which occurred in mid-September. We've had 1, 2, 3 weakening tests of that since. The horizontal red lines represent support levels from previous price action. Black line in the middle is the 30-period regression line. The outside black lines are the channel that are formed by the maximum excursion from the line during the look-back period, which occurred middle of October. The blue river is the 30-period Bollinger Band plus or minus 1 standard deviation. Thick green is 10-period moving average. Thin red is the 50-period moving average. The blue line channel is an extension of the regression channel, showing what the normal price action should be given the previous 30 days of look back. You can see ADX has rolled over and come under 20. Williams percent R10 right on the boundary of oversold, and the jaws of PPO, which signaled the downside move potential back here in late October, still pointing down. Jaws are open to the downside. This thick green looks like a sideways channel. The two yellow ones were the previous sideways channel, so we've only really had 2 very strong days of upward movement. Those have been counteracted by, you can see, at least 1, 2, 3, 4 big sell days going into the election. So next week should be fireworks. Looking at the ETF2 regional report, we have 3 out of the 10 indexes are on a cash position, giving us 70% invested, 30% cash, down slightly from last week's 80-20. EFA, looking at the strength column, EFA, the Euro-Asia Blend, the globals are slightly better than the U.S.'s SPY. Inside the U.S., it's mid caps, small caps, large caps, then tech. The 2 strongest sectors remain Europe and Asia less Japan, the 2 weakest Latin America and Japan. World market model, again, you can see all the large caps in the U.S. are weak. Mids and smalls generally above average. Strength in Europe, selected strength in Asia. Silver and gold and corporate bonds remain strong. Only finance and then healthcare and discretion are above average. This looks more like a return to the defensive plays. Look at the top 30 ETFs from the ETF2 database just for patterns. Home construction remains strong. Emerging market debt, Spain, intermediate credit bond, although the weakening here in strength and consistency should be a concern there. International real estate, global real estate, telecoms, mortgage REITs, emerging market bonds, Hong Kong, healthcare. And looking at the Dow 30 through the same lens in the strength column, you can see Bank of America, Home Depot, JP Morgan, Merck. At the bottom, Hewlett Packard continues to be horrible. Intel, DuPont, Coke, United Health, Boeing. This should be, to me, Coke ought to be of interest to us. Looking at ETF liquidity, this is based on 30-day average daily dollar volume. And those that are in green are exceptionally volatile intraday, make great trading candidates, notably the VIX. And in the red are extremely quiet. Shifting over to the daily report. Couple signals here in channeling for SPY and the Qs. You can see we've been oversold or on the edge of oversold for a while. Pivots for your reference. 10-day max pains, DuPont, McDonald's, Cisco, General Electric, Hewlett Packard, and all of the energy complex here, natural gas, oil service. IBB is the exception there. That's biotech. That may be worth a like a triple screen kind of look. It was extraordinarily strong for a long while. It's starting to crack now, but it looks like a pullback opportunity until proven otherwise. In the auto framer, you can see a handful of ETFs and large caps that test out at better than 2-to-1 just based on trade location. You can see on the volatility here the steady increase of volatility over the last 100 days. Lots of the Dow test out at better than 2-to-1 on the auto framer. You see the 5 max pain range compressions: DuPont, 3M, Pfizer, Cisco, McDonald's. Only one doji in Bank of America. And a handful of channeling and overreactions. A couple triple screens there, Merck and Travelers, to be of interest. Travelers might be really interesting for you because it has a RSI2 closing value of 1, meaning it washed out on Friday, and still has a 3-to-1. It's channeling an overreaction and a triple screen. That's worth your attention. Walmart tests out at 4-to-1. It's channeling an overreaction and had an RSI value of 2. ETFs, same thing, lots of auto-framed possibilities, plenty of channeling and overreaction, 1551W in the VIX. Looking at the market mosaic, 30-day regression line slope is down. You can see it's been declining. It's had a 2 standard deviation move down now compared to the 6-month average. When it crosses this dotted line, it's then a negative slope. This is where the slope went negative. And you can see how it's rolled over. And the percent stretch also has had a 2 standard deviation move. Z-scores of the regression lines, the 90 has come back into normal. The 30 has moved to the bottom of the channel where this would be a natural place for it to find support for a while. The 10 has actually rolled up a little bit back into the river. You can see price with respect to the river is on the downside, just outside the river right there. So there's room now in S&P for a retest of this swing high at about 145. The last time it did this was right here, and instead of an upward test, well, I gave a little upward test and then the big fail. This looks more like the big fail because it rejected the river once already, and it looks more like an 8 to 10% pullback. Regression line crossovers for 4 symbols. You can see the S&P again just outside the river. Weakness in IWM. Gold has pulled back significantly. That's more than I would have expected from this move out of the river, but it is a 50% retracement. If the equities get weak, that could go. Treasury's the only stable thing right here. It's in sideways quiet channel. My target would be 130 on the upside, about 118 on the downside. So Treasuries look favorable to me. The rest of the charts are for reference. And that's all the news from Kansas. We're off to play the final game of our weekend tournament and the final game of our outside season. So let's go Thunder.